What one thing has happened before every single major stock market crash in American history? Let's look at it. So, here's the deal. Inverted yield curve. I'm writing the book, right? I've got this thing going, and we're looking at bonds, okay? And I'm just walking about bonds, and I'm talking about yield curves, and get this. Check this out. In the past, look, here's the deal, right? Yield curves, inverted yield curves. It's what happens when Treasury rates, what they're paying for investors to invest into the U.S. economy, basically a risk-free rate, right? Because the whole U.S. government backs it, and you're investing in a bond. And if you guys don't get any of this, check out the stock lectures, check out the book. It's gonna be full. This is one chapter, right? So we're talking about Treasury yields, and so in a inverted yield, the short-term rates are going to be higher than long-term rates. People think that the rates are going to go down. Everything here, if you don't get this, is in the book. So here's the important part. In the past, 6, 7, 5 major stock crashes, the inverted yield has happened consistently before. I couldn't believe it. So here's the deal, right? You get an inverted yield, and as soon as there's an inverted yield, we got a chart here, right? 1, 2, 3, 4, 5, 6, 5. Yeah, five stock market crashes. Every single one of them is after an inverted yield. When there was an inverted yield in the US Treasury markets, there was a stock market crash. The average number of months, right around 20 to 21 months after there was an inverted yield first, the stock market started crashing. The start of a recession, okay? So here's the deal. This inverted yield is a big deal. I never even So here's the deal, right? You see an inverted yield, and the stock market still got a way to go. Still can go up for sure, 100%. Average return from the start of the inverted yield to the start of the recession is 10%, median, 12% average, right? And this is all straight from the book, guys. So, freaking absolutely insane setup here. It's failed. I think this website, I'm looking at different sources, and they say there was one false breakout with inverted yield curves. So here's the deal. Watch for the inverted yield, because when there's an inverted yield, there's going to be it's a very, very strong historical foresight to a recession. Yeah, it's freaking huge. So, watch for the inverted yield. We're looking mostly with this at 10-year and 2-year Treasury bonds. But if you see an inverted yield curve, you're going to know it. It's, right in the book. This is the chapter. What chapter? This is bonds and interest rates. This is right before technical analysis. So when you guys pick up the book, for sure, watch for inverted yields, because that's when you're going to start to see some really crazy stuff happen in the market. Historically, inverted yields have been precursors to giant recessions, and it's freaking huge. I never knew about it. I thought it was super insane. Just figured out about it. Keep it in your mind. Thanks.